and the pre-open rates are indicating that we could be in for a green start. A rub of green is something what markets want, but I'm afraid it is not a rub of green. It's a gap down start with the positive breath. It's a 5% downtick for the IT index, and that's largely because of the weightage adjustment. The TCS and Infosys, if they both on the same side of the trade, IT goes down. I mean, it's a simple point to bring up. Bank index or the bank Nifty will be off to a great start. Why? Well, that's because of, thank you, HDFC Bank. Reliance is off to a good start, but Infosys is where the collateral damage, I think, is visible. 10% down for Infosys. You don't see a stock like Infosys fall 10%, and this is a stock where I think the selling is not done yet. Numbers have been poor, pathetic, horrible, and they will force everybody to derate the stock. The street is derating large cap IT, and it is derating large cap IT quite vehemently. You got a 3% decline for TCS, you got a 10% decline now for Infosys. Meanwhile, HDFC Bank, Kotak Mahindra Bank and Reliance are looking strong. I want to look at AU Financials. That was the star on Thursday, hit out of the park. Sanjay Agrawal's extension from expected 2 years has become 3 years, but that also is consolidating. Power Grid, Dr. Reddy, iShares, nothing meaty in the market per se. It is adjustment of numbers which I think is very visible. I would say watch out for Tech Mahindra. Their BSFI exposure is low. If the problem is with the BFSI space, then companies which have a limited exposure to BFSI, they will start limping back to normalcy. Companies which have high exposure to BFSI, Mindtree, LTTS, some of those companies in a sense will be in a spot of bother. And HDFC Bank also, by the way, is not reacting to numbers. It's down 1%.
It's actually fallen. So HDFC Bank as well is now down about almost 1% after a bit of a positive start. There's a block deal in Z, so I think that Oppenheimer deal has happened. There were reports indicating that they're looking at selling that 5.6% stake. So just look out for that counter as well. I don't know if we can bring up the volumes that we're clocking right now in Infosys, because the selling, remember, is also coming on the back of huge volumes. Kunal was just highlighting earlier as to how the pre-positioning ahead of the numbers. Remember, on Thursday itself, you had Infi down about almost 2%. So the selling is coming on the back of bigger volumes as well. And not just Infosys, it's pretty much across the board. The Nifty IT index alone is down 6% as we speak right now. I don't recall the last time the index alone, or rather index itself, was down 6.5%. There you go. That's where the Nifty IT index is. Pretty much all the composites of the Nifty IT index are bleeding right now as we speak. TechM, LTIM, Persistent, Forge, they're all the top laggards today. On the flip side though, Power Grid, SBI Card, Eicher Motors, Kotak Bank, DRL. But I must point out that, the IT weakness aside, there's no relative strength either in the market. Your biggest gainer is Eicher Motors on the index, which is also less than 1% higher right now. So that's not really indicating too much inherent strength. But Kunal, you're a better place to comment on this.
Yeah, so I think it's a zone for the markets, where the markets will have to digest a lot of different trends emerging, whether it's HDFC Bank on the upside, whether it's Infosys and IT sector downgrading, or maybe some pairing of positions over there. So we may probably see another couple of days where the markets may go into this adjustment mode, and that's why I think trading the index and finding out direction in this kind of a market would be a lot more difficult. So that's why we probably reduce the trades and look out for more of the patterns emerging. The stock which I would be looking out to trade at the open would be on Tata Chemicals. I think that looks attractive at the 1020 odd mark, and now confirming a breakout in the short term chart. So would be a stock which I would suggest to buy.
Okay. Devina Mehra joins us now. Let's connect with her and let's take our conversation forward. Devina, good morning. Thank you for joining us. It's a sea of red for IT. Is it deserving decline in some of the IT stocks, or this is market reaction which is on the extreme after Infosys numbers?
I would go more towards the latter, that it is a big knee-jerk reaction to results that came out. But is it that is that showing that there's going to be some secular disaster in IT? I don't think so. I mean, what I think this is showing is that yes, there is there are issues in the Western economies, and therefore the sales cycle gets extended, and therefore you don't land as many deals as you hope to within a quarter or so. But I do not see it as being something of a disaster and which will last forever. That's one part on the business side, and there's always uh, where you are in terms of valuations in what is built into a stock price, whether we are talking economies or sectors. I always say that there's no one-to-one correlation, that you can't wait that for things to really improve and then buy something, because by that time the time is past usually. So that is something one has to look at. So if you look at for instance, last year, if you looked at Europe, and we actually made that mistake, that we were sitting at beginning of October and we said, like, now the news from Europe is all going to be very, very bad. So definitely that's not one place where we want to be overweight. But then, both the last quarter of last year and the first quarter of this year, Europe has been the standout performer. So both these factors together, I think it's a bit overdone for sure for IT.
But Devina, has the time come to buy IT just yet? That's the other question, right?
I would say that it is somewhere in the range. I mean, we're still evaluating with our systems, but my first reaction would be that it is definitely in the range.
Devina, but I look through IT and I say, okay, the sector will have a relevance. 2 years, 3 years out, it will have a relevance. But I may get growth between 8 to 12%, 8% on a bad year, 12 to 13% on a good year. So for an investor, where is the upside?
I mean, how many businesses do you have where you have something of a predictability in the first place, and also a rupee dollar hedge? So that's the other part which IT provides. And so that's the other question, that where does that show up? And as I said, this is a really a bad year for their buyers. But this is as a sector, again, if you look globally, the move is towards more and more digitization. In fact, if you go back a year, last year beginning, the issue in IT was that there was too much demand for people. So there was margin pressure from the cost side, because the whole world, whether they were a technology company or not, had to and was moving to technology, which is why there was demand for that many people, along with the startup ecosystem. So that last year we were talking of a different problem altogether, that the whole world wants to go tech, and therefore will they get enough good people? And now we are saying that the demand will not be that great. Tech is not a mature business in that sense that you will not see growth. Again, we are talking at a trough of a cycle in terms of the economies which they cater to. So I don't think that's the thing, that demand is going to dry up for IT.
Devina, what to your mind is going to be the central market talking point for next couple of months? In the month of Jan, it was Adani. In the month of Feb, it was budget. It's been inflation for last 1 year, and it's been the US regional banks for last 6 weeks. Has the puck now moved decisively from these 4-5 factors?
Talking points, actually, you should be worried about. I don't have to go out and talk every day on the markets.
No, that's why I'm asking you, what do we talk? That's why we are asking you, what do we talk?
What to my mind is the going to be the theme, at least for the Indian market, which will drive a lot of factors, and that is crude. So compared to last year highs, we are down 30-35%, and if it sustains there, that is going to drive a lot of things in India. So if I look at RBI, for instance, they've paused on the interest rates, and to my mind, they are waiting for that maybe crude will do the difficult part. So in India, that drives a lot of things. So if crude remains down, it is not just crude. In fact, the part that you're never sure of is whether it will get passed on to the direct fuel, petrol, diesel, all of that. but it also drives a lot of downstream products. So if those prices come down, so that helps, of course, inflation control, because in earlier rounds, whatever inflation coming down we've seen in India has been driven by food, which can't go on forever. Only in this round we saw some other factors change a bit. So inflation control, it therefore can drive demand. So as far as sectors are concerned, if input prices go down, that helps a lot of sectors. So it's like from FMCG to chemicals, textiles, paints, even large parts of the cement cost are linked to this. So there are a whole bunch of sectors where then companies can take a call that do we reduce prices and therefore get a demand boost, or we let the margins expand, or a combination of the two. So if I look at the economy as well as corporate earnings, to my mind, that one theme which can change a lot of things is crude. In the US, it's a different thing. The Fed is talking of something else doing the heavy lifting. You mentioned the banking crisis, so that means tightening credit and tightening financial conditions. So Fed is waiting that whether that itself can do a lot of things which are otherwise supposed to be achieved by increasing interest rates, and so therefore they may not increase interest rates that much if those things happen. And in India's case, I think it's a bet on crude.
Devina, you continue to remain pretty optimistic then when it comes to the entire capital goods, manufacturing theme. So in light of that, what is it that you're expecting in Q4 by way of numbers? Anything in particular that you'd be keeping a close eye on?
Q4, you will have a mixed bag. As I said, if the crude remains at lower prices, it is in Q1 that you will start to see that impact overall. And yes, you're right that we have been very positive on industrial and capital goods for now over a year and a half. So from October 2021, and that's been a big performer for us because stocks have doubled and tripled also. And we still remain overweight, though. I mean, we've been booking profits. So last quarter also we cut a bit. This quarter also we cut a bit, but relative to the index, we are still way overweight. So that's a sector that we continue to like. We've done some reshuffling also, moved from something where it looked like the move was over to something else. But that sector still we remain positive.
So Devina, if let's say in the near term, flows normalize, and which is what is happening globally, money is moving back into emerging markets, dollar index is weak. Do you think in that good old comparison which has haunted India, China versus India, India versus China, actually could work in our favor? Because the money which has gone into the Chinese stock markets last year and beginning of the year has not given satisfactory returns.
It gave returns for a while. In fact, that somebody was asking us that, one thing which worked for you globally, and that was it. We got into China and Hong Kong at the right time, and we got out also at the wrong time, at the right time. I mean, we still have China, but now it's mostly non-tech China. So the tech part was that. So after that, Taiwan was the one which looked good along with semiconductors. So we moved to that. But as far as these FII flows are concerned, I've said it before on your channel also that there is no point spending time focusing on that. And if you look at India versus China, since 2007, the Chinese market is still down so substantially. I don't know what the number would be just now, but it is still down way below the 2007 highs in spite of the economy going up 6-7 times. It is futile to look at those sort of things. And as I have said earlier, when we used to track it, we no longer track it. The FII flows versus the market movement has no correlation whatsoever. So I only now track it from the point of view of impact on balance of payments and FX reserves, but not from the point of view of markets at all.
Okay, Devina, good to have you on the show as always, and keep putting up the food pics. We enjoy just looking at them. You've been gorging on some delicious ones of late.
A lot of festivities.
Good to have that
So
cheer.
I'm willing to participate in all from Easter to Bengali New Year.
Absolutely, and especially for the food. But good
Yeah.
speaking with you as always, Devina. Good to have you on the show. Let's just revisit what the market rates have settled in at. Infi has only gotten worse, by the way. We are now staring at a downtick 11.5% on the Infi futures, 12% now for spot, 12.20 is where we're currently at, and I think soon we would be actually hitting those brokerage slashes. All the price target cuts which came by on Infosys, I think we should be soon there, because the lowest cuts were at 1605. That of course is long gone. 1240 and 1290 was the price target from a Credit Suisse and Nomura respectively. We will even breached those marks because remember, Credit Suisse cut their price target from 1760 all the way to 1240 on Infi, and Nomura from 1660 to 1290. So we're already sub that mark. Those price targets have been met, and that's where we are on Infosys. What about TCS and the likes? What are they up to? Because I can see Techem, LTTS, LTIM, Persistent, they're all getting clobbered in trade, and TCS alone is down about 3%. Tech Mahindra around 6.5% right now. Persistent Systems is down 9.25% in the futures. LTIM is down 9% again, and LTTS as well is down almost about 5.5% as we speak. So the Nifty IT index, of course, is a big drag. Where has HDFC Bank settled in at? Let's just bring up that stock price as well for you, because that also was a little wobbly to start off trade. That also is lower about 1.5%. So a large weightage of the index with Infi, TCS and HDFC Bank is languishing, and that's really bearing heavy on the index as we speak, which also is now down 188 points actually, over a 1% cut. 17,691 is where we're currently at on the Nifty futures as we speak. But let's hear out from Milind Karmarkar and where he's finding opportunities, long term of course, in this market.
I have not been able to identify something which will go 50 times, but I think anything to do with consumption. And the reason I'll tell you, I do believe that overall the per capita income can move from 2,500 to roughly about $5,000–6,000. And if that happens, the boom in consumption can be phenomenal. So I would still continue to identify companies in consumption which can do very well going forward. So I'm not saying that like last time market may go up 6–7 times. We have already gone, we have doubled ourselves. So maybe a double again from here, possibility. But within that, which will go up 5–6 times as of now, I think if one wants to take a bet, it would be in consumption.
Most of the consumption stocks are trading at P multiples which are north of 50.
Absolutely.
That's the benchmark.
Absolutely.
History, since we are examining history here,
Yeah.
historically when P multiples have gone to north of 50, the future returns are always compromised.
Right.
So why do you think history this time will not play for consumer stocks?
Okay. I'll give you an example in apparel. I think overall apparel market in India is about 7 lakh crores. And there is a 8–9% growth in the apparel market year on year. So that means about a 60,000 crore rupees growth is there in the market. If you add the sales of all the organized retail, it still doesn't add up to 60,000. So that is the opportunity. So if the opportunity is large, these companies can grow at 35–40% year on year for next 10–15 years also. And that is the reason why the P multiples may not contract, but at the same time, those 50–60 times seems to be difficult.
So for the organized apparel market, and there are a handful of players here,
Yeah.
do you see them growing individually at 20% for next 3 to 5 years?
Yes, definitely, definitely.
Which means if you are looking at buying some of these listed apparel stocks now, and we'll talk about the themes apart from apparel, if you're buying them even at these P multiples of 50 plus, if the earnings growth is 15–20%, they can still give you a stock market return of 15–20% in 3 to 5 years.
Definitely.
Which
Because
is-
the P's will continue to be high.
But if you're looking at a market which could be as vibrant as what we've seen between 2003 and 2008,
Yes.
then isn't it time to identify real big multi-baggers? Because 20%, 30%, some would say, may
fair
not
enough.
be the best return in this
Fair
kind
enough.
of
I
a
mean,
scenario.
that's the whole game, right? To identify multi-baggers and to hold on to it during this boom. So we are still trying to do it, and I keep my fingers crossed, saying that I should be able to identify at least one or two, because that's more than sufficient. So we're still trying, but it would be in consumption game. That is definite. The space will be consumption.
All right, to stock of the day then, and without a doubt, that's Infosys post its numbers. We've got Pankaj Murarka, who's joining in from Renaissance Investment Managers, D.D. Mishra, Senior Director at Gartner, as well as Ravi Menon of Macquarie, all joining in to give us their outlook on Infosys, as well as the outlook for the tech sector in particular. Let me begin with you then, Mr. Mishra. 10 brokerage downgrade ratings this morning. Target cuts anywhere between 5 to 30%, driven by EPS, as well as multiple cuts coming in across the board. This doesn't come in as much of a surprise post the kind of quarterly numbers, does it?
So the thing is that, I am a bit, optimistic about the IT sector at this point in time. I'll not focus on these numbers much, because the numbers we are looking at are very different from what sometimes it is quoted on the media. We are looking at the numbers in terms of the end user spending growth on the IT services. And if you look at the end user spending growth on the IT services, is going to be somewhere between 9 to 10% in the next 3 years. So that sort of a growth we are expecting from our surveys on the forecast reports, which we have published recently in the month of March 2023. Now, we have also conducted the surveys with the end users, and it was in December 2022, where we realized that the end users are going to spend more, and the focus will be more on the value of optimization, even though we asked them the question around the recession, that whether it is going to impact their cost cutting, and only 15% of them said that only they are going to cut the cost, but most of them are going to spend more. So from that perspective, we see that there is a lot of opportunities which exist in front of the IT service providers at this point in time, even though there is a cautious approach which industry is taking, given the fact that there is a lot of news around something happening around the financial sector. There's a lot of news around the recession, which is still floating around. But again, I would say that this is not impacting the end users in a big way at this point in time.
Ravi Menon, if I scan through your latest note, your take on the current view is that the macros are great and this is just a seasonality which is impacting the Indian IT sector. Why is that? Ravi?
Sorry, what's that mean?
Yeah, Ravi, what's your house view post Infosys numbers on the sector?
See, we do not think that this is a sector-wide issue, and we do not see a significant worry for long-term investors. We think that this is a great opportunity with digital transformation. We see double-digit growth being possible over the next 3 to 5 years. And yes, this quarter has come in softer than expected, especially for Infosys, even for TCS. But if you look at TCS, the absolute revenue that they've had, incremental revenue, which is really a function of the pipeline, that is a good indicator of the demand. This year, they've added exactly the same in constant currency terms as they did last year. So that tells you that the demand environment has not really changed. Yes, and right now, and this is despite the macro worries throughout all of last year in the US. Now, this particular quarter, clients have taken a knee-jerk reaction, we think, because of heightened uncertainty that happened with the SVB collapse. And also in Europe, we've seen there were concerns that a large bank could fail. So with all that, people had just put a pause on CapEx, but we think that will return. It's just a matter of time. Maybe a few months later, we should see that come back. And structurally, we think we are on good growth trajectory.
Pankaj, good morning. Pankaj, last quarter, which is Q3, Infosys came out and upgraded their guidance. Q4, they come out, they slashed the guidance. What amazes me is that Infosys is claiming that we are running models of AI forecasting to help the world. Here, they are getting their own forecast wrong. What is going on?
Well, morning, Nikunj. What this tells you is the world is unpredictable and it's a very volatile place to do business. If large companies like Infosys, which deals with a majority of Fortune 500 and Fortune 2000 clients, they cannot predict their business or foresee their business for a quarter, then things are changing too fast. And I think that was a similar comment from TCS as well. I think the fact is that companies entered into the January quarter while there was some degree of caution late last calendar year on around impending rising rates and impending recession in US. But things really did turn bad in the first quarter because of the fallout of this financial crisis and or blow up of some of the smaller banks and the CSAP incident, which actually has turned larger banks and financial institutions much careful and cautious in their approach to business. And as a result, what is really emerging now from the commentary from these companies and some other data points that we get to infer from is that clients, especially in financial services, are deferring short-term projects. They're not canceling the projects, they're not calling out the projects, but they're certainly deferring it. And they continue with their long-term projects. More importantly, both the companies, including Accenture, also highlighted the fact there is a significant deal momentum in vendor consolidation. So that's what we typically see in a downturn, where companies want to increase efficiencies of the IT spend. So they want to deal with less vendors and they want to drive more efficiency out of the same dollar they spend. So vendor consolidation deal are witnessing a strong momentum. And likewise, you're seeing cost takeout deals seeing a lot of traction because in a downturn, companies want to take cost out of their system. And while they continue with their long-term deals, the short-term deals are seeing deferrals, and which is what is again evident across three companies, Accenture, TCS, and Infosys. The growth in financial services has been much lower than overall aggregate company growth. So financial services has been lagging as a vertical for all these companies. So I think given the probably we're still yet not in the middle of a recession in US, which is likely to play out over the second half of this calendar year, I think financial services will remain weak for IT services and it will have short-term impact over the next 2 to 3 quarters on the growth for those companies. So for a typical company like Infosys, which could have done a double-digit growth for next year, probably now I think they've themselves guided for mid-single-digit kind of a growth for next year. So it has taken off anywhere between 2 to 4% growth away from larger companies in that sense, at least for the next 1 year.
Pankaj, so from a market standpoint, when we started the year, today the terminal value is changing. How much of a single digit or a mid-single digit is something which is now going to get priced in after another 5-7% fall? Because one differentiating factor, Pankaj, in the book is that some of the IT companies also are using buyback to stem the market fall.
Well, because my view is that terminal value doesn't change much because when you're talking terminal value, you're taking a 20-year view on these businesses. I think the directional overarching major trends in terms of companies wanting to digitize, wanting to spend more and do much more. Companies, especially in financial services, have to invest a whole lot into cybersecurity, in data analytics, and in terms of improving their architecture, because a large part of financial services globally operates on legacy architecture systems. And with the transition to cloud, it's forcing these companies, global banks and financial services companies, to accelerate their transition to new generation technology platforms, and it becomes essential for their survival. So I think while there's a cyclical slowdown or a recession in US, which is making these companies, especially in financial services, more cautious, because all of us know that if you have a recession or economic crisis, financial sector tends to be at the center of it. And having learned or gone through such crises in the past few decades, some of these crises in the past few decades, the wiser or the larger financial services firms and banks are tending to be much more cautious. I think the longer term outlook for Indian IT companies doesn't change and for the IT sector doesn't change. But having said that, in the short term or near term or the next 1 year, it has business implication, and I think which is what stock prices are reflecting. Markets in any ways are pricing in earnings or growth over the next 12 to 18 months. Markets don't price 5 years growth today. And from that perspective, when we look at the next 12 or 18 months, yes, there is earnings slowdown in these companies, and I think which is what markets are pricing now.
Ravi, I go back to that very basic fact, which is that Indian IT companies, they will continue to grow. But it is the rate, Ravi, what we are discussing and debating. One side I see a huge order book which both TCS and Infosys have reported. I expect the same from HCL Tech and even Wipro. So my question, Ravi, is that if the order books are strong, then why is there a ramp down? I mean, they both don't coexist. If you are getting order, that means you see visibility. If there is visibility, why is there is no growth?
So if you look at TCS, it has grown, right? Infy has seen a decline. And honestly, we are a bit puzzled by that because typically you see about 95-96% of your existing book of business should just roll over. So even if there are delayed project starts, it doesn't really explain a decline. So you're right there, and we don't really have the answers for that. But if there is slight growth, and from here, that's actually just people putting capex points on hold. When there is uncertainty, clients react like that. But that hasn't changed, their cost structure one bit, right? You just put that on hold, and you might save cash for the next month. But to take out cost structure, like Pankaj was saying, we see a lot of deals in the market which are structural cost takeout. And these mega deals that are out of the market, for the first time going into a US recession, Indian IT vendors are strategic vendors who are well positioned to win these. And that is why we are confident that growth momentum will continue. You might have one more, 2 more soft quarters at worst, but I think beyond that, we should see growth recovering. And we are definitely in the growth phase after we've seen pre-COVID, right? Post-COVID, growth rates are significantly higher, and therefore we believe that a higher multiple is also deserved post-COVID.
So, Mr. Mishra, given the kind of projections that you have, all in all for Infosys, what's the outlook going down the line in terms of what you believe some of the challenges will be, and do you believe that down the line that the market is purely factoring in some of these challenges, and that growth down the line is looking pretty decent for the IT sector as a whole?
Yeah, so I am a bit optimistic with the IT sector, and there is not enough to read out of the recent numbers or quarterly numbers at this point in time. We have asked a specific question to the end users that whether they want to increase their budget or not, and average kind of increase which came out was around 10% from the end user community on IT service spending. So from that perspective, we don't see that going further, it is going to be challenged. Now, what will happen is that you have to look at the changes which are happening in the market. Now, the prioritization will be necessary, that where the changes is going to happen and how to prepare for that. Maybe that disruption may come a little bit faster than we anticipate, and which lead to some of the conversations around the ramp up and ramp downs. But it needs to be seen in isolation, and it needs to be seen from case to case basis, rather than making a very generalistic statement on top of it. So these changes are quite common, and change is the only constant, I would say, at this point in time. It has been there with the IT industry for a very long time as well. And these sort of changes has been there for Indian IT services companies. And I agree with one of your panelists who said that Indian IT services companies are much smarter in navigating through these changes. So we have seen, still I would say that the attrition rates are close to 20%. And one of the numbers which you need to also understand that, why these attrition rates are so high if there is a slowdown in demand. So, and also it is not, going to significantly impact at this point in time, looking at the numbers which we see, which we are seeing. And hence, that sort of an optimism is there. But again, there are many variables, there are many unknowns at this point in time, which we need to also consider. And we need to keep reviewing this every quarter so that, we remain in track with what is happening at this point in time.
It's been a pleasure having you on board. Thank you so much, Mr. Mishra, as well as Ravi and Pankaj, for taking time out and joining in, giving us your overall view on the IT sector. Meantime, the damage continues on the stock prices. Infosys being seeing the biggest cut in today's trading session, but the likes of Wipro as well as HCL Technologies, Persistence, etc., not being spared in trade. Tell you what, we'll take a very quick break right here on the show. Don't go anywhere. Stay with us, as when we come back, we've got Mr. Anthony Capuano, who is the President and CEO at Marriott International, joining in to talk about their India plan, its domestic portfolio, and where they see the travel industry headed.
Mr. Anthony Capano Jones, President and CEO with Marriott International. Hotel industry and hospitality industry globally is going through a very strong patch. So is this more like an India phenomenon or global phenomenon? Anthony, good morning. Thank you for joining us. It's your first time on ET now. So welcome and hope you're enjoying your stay in India. So Anthony, I'm going to pick up something which you've mentioned in the past. You've said that despite interest rate environment, inflation and global geopolitical problems, the recovery in the hospitality or the hotel industry is real. It's beyond a sugar rush. What is fueling this optimism for you?
Well, certainly the data that we've seen, we are a data-driven company. And when we look at forward bookings, when we talk to our business transient customers, our leisure customers, our group meeting and conference attendees, we have seen extraordinary resilience in travel. The impact of the pandemic, I think, if anything, has acted as a bit of an accelerant and a powerful reminder of the impact of in-person interactions, whether that be for business or leisure. We also, in many markets around the world, continue to see an exceedingly strong consumer balance sheet, and we see strong employment numbers in many inbound and outbound markets around the world. And it's the confluence of those factors that continues to drive strong and growing demand. And it's those demand patterns that drives our optimism about the continued recovery of our business and of the travel industry more broadly.
Anthony, 2002 saw the company set records for the fees adjusted EBITDA. What kind of revenue or ARPU did you clock, and what is the outlook for FY23?
So as you point out, 2022 was a record performance year for Marriott. We posted record fees, record EBITDA, record EPS. And I would remind you that we achieved that performance in spite of the fact that January was very difficult last year because of the impact of the Omicron variant. And the China market was largely locked down for the bulk of the year. So we continue to expect increased performance into 23 and beyond. During the fourth quarter earnings call, we gave a bit of guidance, and we said we expect to see global RevPAR grow between 6 and 11% in 2023. Now that 500 basis points range is a little wider range than we've offered historically. And I think the width of that range is appropriate given some of the economic headwinds and some of the economic uncertainty that's out there. But achieving something in that range would still be a powerful reflection of the continued recovery of travel.
Now, you've seen a 25% recovery of cross-border travel in and out of Asia Pacific. Given your footprint, what kind of opportunity does this present for the APAC region?
It represents a tremendous opportunity, not just for the Asia Pacific region as a sub-region, but for our global business. If you look back at a pre-pandemic period, 2018, 2019, nearly 20% of our global room nights were represented by cross-border trips. In the early days of the pandemic, that percentage dropped to very low single digits. And as the recovery has evolved, we've seen fairly steady improvement. But even in the fourth quarter of last year, only about 16% of our total room nights were represented by cross-border trips. And so we think there is still meaningful upside as the recovery continues, as borders continue to open, and as the ability for travelers to cross borders becomes more and more frictionless.
So you mentioned that you have an exciting and a long runway of growth outside India. Tell us some more about it.
Of course, and I'll give you just a bit of context. If you look at the company's global portfolio at the end of 2022, in round numbers, we enjoy about a 16% market share in the US, our largest market. But outside the US, we only have between a 3 and 4% market share. So over the next several decades, the runway for growth, as you describe it, is very significant in terms of our international distribution. We continue to see strong, rapid growth across most of Asia Pacific. The Middle East is a terrific set of growth markets for us. We see big opportunity in Europe. And the Caribbean and Latin America is quite exciting for us. And as you've likely seen in some of our announcements, in the next month or two, we'll close on the acquisition of a large Mexican chain called City Express. And that acquisition will achieve a few objectives for the company. It will solidify our leadership position in the Caribbean and Latin America region, but it also signals our entry into the mid-scale segment. And that's a segment where we think we have growth opportunities, certainly in the CALA region, but potentially on a global basis as well.
Signing in Q2 accelerated. The company signed on an average 2 deals a day for a total of about 700 plus management contracts and franchises, which is almost a 20% growth in terms of total signings. What does this year look like?
Well, as you may know, early in my career, I was responsible for the company's global development efforts. And so to me, year over year growth is always the objective and always the priority. We're off to a great start, and we'll talk more about that in a few weeks in our first quarter earnings call. But I'm quite encouraged about our pace of signings, our pace of MOU signings. Just while I've been here in India this week, I've been talking with many of our Indian owners, and their optimism about the continued recovery and what that recovery means in terms of their appetite for continued investment in Marriott's brands across India is very, very encouraging.
You earn a significant portion of fee-based revenue from top line. What kind of projections do you have, and what are the profitability drivers there?
Well, we've not given forecasts beyond RevPAR forecasts or guidance, for 2023. But we certainly are bullish that the continued recovery of the industry will continue to drive both top line revenue, but also profitability for our owner and franchisee community around the world. And we had the good fortune to spend a bit of time with Prime Minister Modi yesterday. And one of the things we talked about was how focused we are on the financial health of our owner community here in India.
You're present in 40 cities in India, currently have a target of 200 hotels by 25. Are you on track for that?
We are. In fact, at the HICSA conference earlier this week in Bangalore, I talked about a goal we've set for ourselves that by 2025, between open and pipeline hotels, we'll have at least 250 hotels. And I think that really just reflects us getting started. Today, India is our fourth largest market in terms of our footprint. I've had the privilege to spend the week with our India team, and I can tell you are keenly focused on moving up the rankings. We're very bullish about the political stability and environment here in India. We're excited about the broad range of diverse markets and experiences that the country has to offer. We are excited about the passion that our owner community has to continue to invest and grow in India. We talked at length with your Prime Minister yesterday and with your Tourism Minister about what a strategic focus area travel and tourism represents as part of the broader macroeconomic priorities. And so India, from a travel and tourism perspective, has a very, very bright future, and we want to be a meaningful part of that. We are humbled and excited about the fact that we have the largest footprint of rooms across India today of any lodging company, and we want to continue to grow our portfolio here in this really exciting set of markets.
Anthony, it's your first time on ET now, so it was great to have you, and certainly hope to see much more of you going forward.
All right. Move on then from hospitality to auto, talk a little bit then about what the outlook has been when it comes to M&M in terms of the export, the capex plans, new plants. And we've got with us Hemant Sikka, who's President Farm Equipment Sector of M&M, joining us on the show. Thank you so much for being with us. To begin with, given that FY23 so far has been a record year for the tractor industry, you've registered double-digit growth. What's in store for FY24? Because the IMD has given their projections. We know what's in store when it comes to the election year. So what is it that you're penciling in?
So as you rightly said, FY23 has been a record year for the industry. The industry has clocked tremendous volume of 9,45,000. And just to share with you, just about 4 years back, this volume was 7,10,000 odd numbers for the industry. So in the last 4 years, the industry has grown from almost like 7,10,000 to 945, which is kind of growth of more than 33%. So the industry has been on steroids. Last year was very successful year, and we are all very happy about it. Coming to Al Nino, as you have seen in the last couple of days, IMD has come up with a near normal monsoon guidance for Al Nino, which is again a very positive sign for the industry to go forward. Having said that, I just want to also share with your channel that Al Nino correlation with the growth in the tractor industry is not very strong. In the last 25 years, we have had 5 cases of El Nino years, but only in 2 cases out of those 5 years did we have a tractor industry degrowth, which was in the year 2002 and 2015. Whereas in the year 2004 and 2009, when it was a strong El Nino, the tractor industry actually grew very well. And in the 5th year, it was a neutral for the industry. Industry didn't grow or degrow anyways. So out of the 5 instances of El Nino in the last 25 years, only 2 had a tractor industry degrowth. So El Nino correlation with tractor industry degrowth is not very strong. Having said that, El Nino is a weather pattern. And since it is a weather pattern, at some point of time, El Nino has to happen. But looking at the industry performance last year and all other factors which we will talk about, I'm very clear that if El Nino was to happen, I think this is the best year for Indian tractor industry that El Nino happens this year. So we are all prepared for it, and I think the industry will hold very well with this.
Right. Hemant, you've also announced the new brand for tractors, right? Oja. With this launch, how is it that one should expect the market share gain when we are seeing increased competition as well in this particular segment?
So in FY23, we have done very well in terms of a market share. Last year, we grew our market share by 1.2 percentage points, and our market share now stands way above 41%. Our market share closer for FY23 was closer to 41.2%, which is kind of our best ever market share that we have had. So with this, we believe that we are on a very strong footing, and with the new range of tractors, which we have just announced a brand called Mahindra Oja, which is a new series of tractors. We don't play in this segment so far, and this will all be incremental volume for us. These are lightweight tractors. 4 different platforms will be launched in 40 different variants all over the country and in other countries like USA, Southeast Asia, and in Japan. This is going to be a simultaneously global launch sometime in the second quarter, and we believe that this will further help us gain strength on our market share. So we already are sitting on a very good market share, but we believe because in the segments of lightweight tractors we were not participating, and this new range of tractors Mahindra Oja will help us participate in those markets and do well. So all this will help us further grow our market share in FY24.
You used margins. You used to enjoy margins over 20%, but in FY23 your margins have been under pressure. Do you think in FY24 you can crawl back up?
So 2.5 years back, we all know that commodity prices were on an unprecedented increase, never seen before this kind of increase. And obviously this was putting a lot of input cost pressure on every manufacturer. And since we consume a lot of commodities directly, it was also putting pressure on our margins. Having said that, we actually did a very smart strategy of passing on these margins, not in 1 or 2 goes, but over several small stages. So every year in the last 2.5 years, we have taken 3 to 4 price increases. These price increases have got very well established in the market, and the farmers have been able to absorb this kind of price increases. And as a result, you have seen in the last 2 to 3 quarters, our margins have started to come back very strongly. I believe that with the kind of work that we are doing in terms of our own value engineering and the cost control that we have been able to establish, and the commodities looking like remaining stable, our margins should hold very well. I won't be able to give any guidance on margins because we have still not announced our last quarter results. So I can't say anything more on this.
You increased your stake in Swaraj Engines. So how are you, getting benefited by these synergies? How is it going to help your margin profile?
So Swaraj engine, was supplying and continues to supply all the engines to Swaraj tractors on a 100% basis. So this is like a captive plant, which was a separate company, which continues to be a separate company and supplying as a single customer to Swaraj tractors. So we have bought a stake with other partners, and now our stake has gone up, and we believe that this is a very strong company and it will continue to do very in terms of cost economics, economies of scale. It plays like any other business for us. And as the commodities cool off, the margins naturally tend to be better. So we are trying to make sure that as we increase capacity in Swaraj, as I told you that we are establishing a new plant for Swaraj also near Mohali. So obviously all those incremental volumes also go to Swaraj engines.
Right. Hemant, also, can we see you merging Swaraj engine into the mother company? And is that a part of the long-term plan at all?
I won't be able to comment on that.
Okay. Now that we are seeing the performance of your international subsidiaries getting better, tell us what's the plan regarding exports? How much contribution do you plan to get from there?
So we are very excited about our new series of tractors called Mahindra Oja. Last week we have announced the brand, and right now we are at the last stages of our product quality checks and getting our processes ready in our various plants. Overall, I believe that the product has come out very well. It is a new series of tractors, lightweight series, where we currently do not participate. So all of this will help us gain a market share for us. We believe that in the next few months, the production will start, and sometime in the later part of the second quarter, we should be able to launch this product. We have not decided on the exact date, but as we decide, we will let you know. The product has come out very well. It has got huge potential in the country, and we believe that the product will also do very well in the markets of USA, Japan, and Southeast Asian countries. Plus, there are other markets that we are exploring, which will further add to our volume. So we believe that on the back of Mahindra Oja, the export performance from India will also improve for us.
Now, so if we see farm implementations business today, the industry is about 1.5 times that of the tractor industry. But in India, 10 to 20%. Why is that? I mean, why is that the farm equipment industry so small?
So last year was very good for us in farm machinery. We had gone publicly and stated that this is a growth area for us. Happy to share with you that last year we grew farm machinery business by 40%. And this is on the back of some excellent products that we have launched. We have gained market shares in various segments, and we have also improved our supply chain. Going forward in FY24, we continue to do all the good work that we have done in the last year, plus launch a couple of more products in various quarters as we go ahead. And this will again help us gain market share and enter into categories where we currently do not participate. So on the back of 40% growth in FY23, I expect that we will have similar or even better growth in FY24 in the farm machinery business.
All right, and given the fact that you're expanding your product range, you're setting up a new plant, tell us a little bit more about the company's capex plans.
So generally we don't share year by capex plan, but we have shared our 3-year cycle capex plan. So in the current 3-year cycle which is running, we are planning to expand on our capacity in various plants, plus setting up an all new plant for Swaraj tractors near Mohali, plus the new series of tractors called Mahindra Oja, and there are other platforms which are getting developed. So for our total expense of capacity augmentation, getting up a new plant ready and getting all our new products ready, in the 3-year cycle, we are expecting to spend about 3,000 crores on the capex.
Good to have you on board. Thanks much for taking time out and joining in and giving us a take on how business is shaping up for you. Time for a very short break. Be right back as we get you some chartbuster ideas and lots of stocks in news.